Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. In today's video, I'm going to answer a question from a viewer who was asking about value versus growth investments and then core or blend in the middle. What do they all mean? Here's the email he sent me. He said, "Hey Rob, I use personal capital to check and modify my allocations. I think it's a wonderful tool. However, I'm confused on what is meant by the term core. Portfolio Visualizer uses just value and growth. It doesn't use a core or blend." And he included a picture of both. Thanks, David. So I'm going to answer David's question, but I'm going to take it a step further. We're going to look at value and core and growth and what they mean and how they look in these tools. I'll show you both personal capital and portfolio visualizer. But then we're going to answer the question, well, so what? Okay, fine. We can categorize an investment in one of those three buckets, but who cares? In fact, I'm going to show you why I think those classifications actually explain a lot of how various investments have performed this year. And as you can probably guess, they haven't performed very well. But how growth investments have performed, for example, are completely different than how value investments have performed. And I don't think that's a surprise. All right, so let's get right to it. Let me show you my screen. And we're going to begin, we'll actually begin with a portfolio visualizer. So I just ran through their asset allocation tool. This is the three fund portfolio. So total US stock market, total international, and then a total bond fund. And when you first run this analysis, this is what you see. And we then go to the exposure tab right here. And you can see it will show you how much of your portfolio, in this case, the three fund portfolio, is in large cap value and how much is in large cap growth. And then mid cap and small cap, and you see the percentages all the way over here. You'll notice that's all they have. There's no blend or core categorization. Now let's look at something similar. This is a demo account in Personal Capital that I've shown you many times before. And all I've done is gone to the investing tab here and then down to allocation. And when you first do that, you actually see this. It shows you your total asset allocation. This actually shows it over all of these kind of different portfolios that I've added over time for various videos. But if we drill down, we'll just drill down into US stocks. You can see it has value. That's on the left side here. You can see large cap value, mid cap, and let me move this over a bit and maybe get rid of that, make it a little bigger, and small cap value. And then the middle section shows core, and then the right-hand section shows growth. All right, now, first of all, what's the difference? So this is a way to categorize an individual stock. I'll show you in a minute. You can categorize an ETF or mutual fund between value, core, or growth. And then, of course, you can categorize an entire portfolio, which is actually what we're looking at here. This is actually a large number of portfolios and investments, and we're looking at the total picture of the entire portfolio. Now, keep in mind that this characterization really deals with valuations. What is the value of a company given its price relative to its earnings, perhaps to its revenue or its net worth, its book value? And so really, it's nothing more than dividing them up. And so those companies that say are the most expensive, say they have the highest price to earnings ratios, for example, would be classified as growth. Those that would be on the lower end would be classified as value. And then those in the middle are classified as core. Sometimes you'll refer to them as a blend, and we'll look at that actually in a minute when we go to Morningstar. And the thing is that for whatever reason, Portfolio Visualizer doesn't put them in three buckets. It just puts them in two. Here, one half's over in the value bucket and one half's over in the growth bucket. Personally, I find having the three categorizations, value, core, or blend in the middle, and then growth, as a little more helpful, because at some level, this is just a continuum. You can have some companies that are growth companies, but they're really extreme, maybe PEs in the hundreds or even in the thousands, while another growth company might have a PE of, let's say, 50. Well, that's a pretty big difference, and you see that as it moves towards blend. And then you have a lot of companies that are kind of in the middle. In fact, there might be some companies or funds that if you only had value and growth could actually flip back and forth between the two as their prices went up and down. And so I think it is helpful. And most tools that I've seen have that core or blend in the middle. And that's one of the reasons I like personal capital so much. And so we can drill down into any one of these categories and see what investments we own that make up that category. So for example, we'll just drill down into large cap value, and we can see these are ETFs. VTI is a total U.S. Stock market. VU is the S&P 500. And so part of what makes up the value portion of this portfolio comes from VU. But check this out. If we go to core, well, we see VU is there as well as VTI. And if we go to large cap growth, guess what? They're there as well. Why is that? It's because those are total market portfolios. VU is focused on large companies. VTI is the entire U.S. market. But it kind of has a little bit of everything in it. So it'll end up in part in each of those categories. On the other hand, let's look at a different example. Let's look here. This is Bank of America, and this is Wells Fargo. These are classically considered value companies. So if we go over back to the U.S. stocks and go to the core, we shouldn't see them in there. And yeah, they are not. And they're certainly not going to be in the growth category. So that's sort of, I think, a general understanding of value versus core versus growth. This is how you can drill down in personal capital, and I'll leave a link to personal capital below the video. It's one of my favorite tools and a partner of the channel. But I think this is probably the best asset allocation tool you can find. And in fact, you can look at your entire portfolio like we've done here, or you can actually select and just look at one account, or just your retirement accounts, or just your taxable accounts. So that's value versus core versus growth. And again, kind of why personal portfolio visualizer doesn't use a blend or core category as well. I guess it was just a decision the developers made. I do think having that middle category is helpful. Now, I showed that to you in personal capital. Let me actually show it to you now in Morningstar. So what this is Morningstar's portfolio. And let me just back up for a second. If we go to a regular page, and we're going to come back to this one, we often look at this portfolio tab to evaluate an individual ETF or mutual fund. But there's also a portfolio tab over here. And that actually takes you to a place where you can, if you have an account, can monitor your portfolio in Morningstar. Now, I tend to use personal capital now. It's just easier, and I like the interface better. But still, this gives you very similar information. So this particular portfolio is just a 3-fund portfolio that I created, again, for demonstration purposes. And I go to this X-ray tab and the X-ray overview, and you can see this very familiar Morningstar style box, and it shows us what percentage of our portfolio is in each of these categories. And you can see it's certainly tilted towards growth, but plenty of core, they call it core here, and plenty of value as well. So that would be another way to kind of get the same information. Now, what does all this mean? It's like, okay, great, Rob, I get it, fine, so what, who cares? Well, those classifications can tell us a lot about how different investments will perform in different environments. So over the last decade or so, growth funds have clobbered value investments. And as you may know, here in 2022, that's started to change. I'm going to show you an example. But the question is why? Why did growth do so well for so long? And why are value investments now maybe doing a bit better, which in this environment means not losing as much? And then what's that do for our portfolio? How should we think about it? And here's, I think, a concept that I think is one of the most important to learn as an investor, and it's this. When a particular investment's doing extremely well, think ARK in 2020 was up, about 150%, or Bitcoin when it soared to 70,000 a coin. There's always a narrative that goes with that outsized performance. In the case of ARK, it was that it invests in high-tech companies that could, and this is true, could change the world as we know it, depending on how their technologies, whether it's in the medical field or climate or whatever, whether they turn out to be successful. And it's a narrative that I think is factually true. It's correct. And there's a narrative for Bitcoin, right? That there's a limit to how much they can mine. It's not subject to the whims of a central banker. And so, you can move it electronically very easily. So there's this narrative that with Bitcoin, and I think that narrative is factually true as well. But here's the thing. Sometimes you can believe too much in the narrative. The deal is the narrative can be true and still not explain why that particular investment has gone up in value so much, or certainly not explain it fully. And one of the big explanations, in my view, for why ARK went sky high as it did and why Bitcoin did was because interest rates were so low, because there was so much money supply in the system and interest rates were at historic lows. So people had plenty of cash. They weren't getting any interest on their savings accounts, that's for sure. They weren't getting any interest on bonds. And so they were willing to take these bets. However, as interest rates start to go up, the growth kind of investments tend to then underperform and value investments tend to do better. Again, it's all relative. So when interest rates are low or are moving down, growth investments tend to do better. When interest rates are high or they're moving up like we see now, value investments tend to do better. And we can look at that. I'll show you specific examples. We're going to look at three. The first is Schwab US Dividend Equity. And we can see in the well-known style box from Morningstar, it's the blue dot. It's squarely within the value column. All right, there's one example. We're going to look at its performance in just a minute. This is just an S&P 500. Its valuation, it's a little tilted towards growth, but clearly in the blend. That's what BLD means, or core, same thing. The blend column. All right, we're going to look at its performance in just a minute. And then we have the QQQ. Many of you asked me about this fund, invest in high tech, a lot of growth, and you can see, sure enough, squarely within this growth column. Now, how have they done this year? Well, year to date, the Schwab, this is a value fund, is lost we'll call it 4.3%. And this is as of just the other day. How about the S&P 500? Well, it's lost 12.6%. All right. And what about the QQQ? Well, it's lost 21.23%. We see now, we're kind of like living in a real life experiment. We're seeing exactly how a movement in interest rates affect value investments, core or blend investments, and growth investments. Of course, if some point interest rates start to go down significantly, you could see all of that reverse. So that's a great example of how these things work. That leaves us sort of with a final question, and that is, all right, well, what do we do with this? So now what do we do? Do we pile into value, or what do we do? My approach has always been, for the most part, to stick with an overall portfolio that falls within the core or blend and has exposure to everything. So again, you could think of a total U.S. stock market fund, for example. Its overall valuation is going to be core. In fact, we can actually look at that very quickly just by looking at VTI. And here it is. And if we go to the portfolio, the overall portfolio is going to be, it's tilted towards growth, but it's in blend, right? And we saw this actually here when we looked at each of these segments and we saw VTI was in all three of them. So its overall sort of tilt, if you will, is blend, but it has investments in value, blend, and growth. That has been sort of my overall approach. If I've tilted it all one way or the other, it's always been towards value, but never to a point where my overall portfolio would fall outside of sort of a blend or core. And why is that? Well, kind of like what we're seeing. The reality is sometimes growth outperforms, sometimes value outperforms. It's very difficult to predict when that's going to change. We've all known that interest rates have to go up at some point, but honestly, we've known that for a decade. No one really knew when. In hindsight, it always seems to make sense, but ahead of time, it's incredibly difficult to predict. So if you were to look at my portfolio in, say, personal capital, the overall allocation for stocks would fall within that core, but there would be plenty of exposure in value, plenty of exposure in growth, and probably a little bit more exposure in value than growth. That's just been my preference for 30 plus years of investing. Here's the real key. One is to know what your portfolio is. Again, you can use Morningstar, you can use Personal Capital, whatever tool. I guess you could use Portfolio Visualizer, but you'll only get the growth versus value. You won't see a core or blend. But use a tool to understand where your portfolio sits right now. And then I think the next big question is, what are you comfortable with that you can leave it alone, kind of forever, right? The problem with extreme tilts towards growth or value is that whichever one you might pick, it's going to significantly underperform the market as a whole for extended periods of time, and you're not going to know when. That is very difficult, I think, to stick with. It would have been very difficult to have a heavily tilted value portfolio over the last decade, and watching just how you're missing out on what could be double-digit returns for upwards of a decade. That's, I think, very hard for most people to do. But at the end of the day, that's a decision you have to make. I think the key is, are you comfortable enough with the portfolio so that you can stick with it through any market? That's at least been my approach. And so while I do have a slight tilt towards value, my overall portfolio falls within that core or blend column. So there you go. David, hope that hope that answered your question. Value versus core and blend versus growth. That's how you can see it in action play out even this year as interest rates rise among the various investments that we looked at in Morningstar. If you have any questions, let me know. Be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.